If you ask the internet what it costs to tokenize an asset, you get marketing. But every company that ran a tokenized offering under Regulation A filed a mandatory itemized fee table with the SEC, with the law firm named. We read all of them. 13,000 filings, every offering since 2015. The answer has 3 eras, and in the middle one, a single legal bill came to $2 million. Not what a tokenization platform costs to build, which is what the vendors price. What the issuers who did it told their regulator it cost. One limit up front. This measures offering expenses, not build cost, not the cost of staying, not what a sponsor absorbed. Every top-ranked page on this question is vendor or agency marketing. Not one cites a filing, an issuer, or a source of any kind. They also do not agree. In that ranked set, the legal and compliance line alone is quoted at 3 ranges that do not overlap. One floor 28 times another. The vendors are not lying. They are pricing a different thing, a platform build plus advisory. But a range with no population and no filing behind it is not a number. Most tokenized deals run under Regulation D, where the form asks only for commissions and finder's fees. The one exemption with a real cost table is the one almost nobody uses. That is Regulation A, Part 1, Item 4. Not pros, named, machine-readable fields. Sales commissions, finder's fees, auditor fees with the audit firm named, legal fees with the law firm named, promoter's fees, blue sky fees, 7 named fee lines, and 1 free text box for anything they miss. Remember the box. Then the same fields come back with the amounts actually paid on the annual report and the exit report. Estimates lane, actuals lane. 13,129 filings. Every offering since Regulation A+ took effect through the 5th of August. 0 parse failures. And the proof nobody read these 2 columns is the SEC's own paper. In May 2025, its economists published a decade retrospective off this fee table. Footnote 17 names the fields they used: underwriter, sales agent, promoter, finder. No legal fee, no auditor fee. Not the first cost analysis ever. The first one compiled from filings. The median Regulation A issuer tells the SEC it expects to pay $30,000 in legal fees and $15,000 in audit. The ones who came back and reported what they paid, about $35,014. They guessed their own bill right. One trap. Most of these are amendments restating the same offering, and one file number carries 111. Per filing, the median is $40,000. Per offering, $30,000. What does move is fees as a share of the raise. From estimate to actual, it triples, and that is the denominator shrinking, not costs running over. 30 and 15 for 11 years. Hold on to the 11 years. Now sort every tokenized Regulation A offering by the year it was first filed. 2015 to 2018, before anybody had done it. 175,000 against a conventional 40,000. 4.4 times. 2019 to 2021, the pioneers. 825,000 against 25,000. 33 times the going rate. 2022 to today. 40,000 against 35. 1.1 times. 8 offerings carry that middle number, so here are all 8. Check the median yourself. That is the answer to the title question. At the median, the pioneer years cost $825,000 in legal fees. Today, about $40,000. Now the column nobody looks at. Conventional median, $30,000 in 2015. In 2019, the year Blockstack paid $1.5 million, still $30,000. This year, $31,000. 11 years, no decline. So tokenization did not get cheap. Nothing got cheap. The ordinary price never moved. What collapsed was the premium. And 4 tokenized offerings sit at or below the conventional 25th percentile. 2 of them at $5,000. Not shifted. Bimodal. So the question is not what tokenization costs. It is what those 8 were buying. In April 2021, a company called Props filed its annual report. Legal fees, $2,085,000. Auditor, $250,000. The tokens were never sold. They went to app users as rewards, and the filing says so. Distributed for no cash consideration. Put those 2 together. They spent $2.3 million to give tokens away legally. That is the extreme version of something that happened 4 times. Every $1 million tokenized legal bill in 11 years belongs to Wilson Sonsini Goodrich and Rosati, a firm absent from the top 14 Regulation A firms.
Blockstack's filing shows what that buys. $1.5 million to Wilson Sonsini, and 1 line in the free text box. Up to an additional $1,050,000 in fees for software, web development, investor verification, printing, advertising. Investor verification appears in 4 filings out of 13,000. All 4 are Blockstack. And what they bought it into? Their own lawyers wrote in October 2019 that no venue had been approved to trade tokens that are securities. Props qualified, then discontinued its primary business operations. What the pioneers bought was the precedent. Everyone after them buys a Regulation A filing from a Regulation A shop. EnduraCoin, 5,000, Monitor Law. Freeport and Ohane, 60,000 each. CrowdCheck, the most common Regulation A firm. Templates did not do it. The pioneers' own counsel published the opposite, and the ordinary fee line never fell. Tokenization stopped being a securities law question and became a transfer agent implementation detail. Now the box. 40% of offerings put something in it. 3% use it to name a cost the 7 lines do not cover. And the strongest finding in this dataset is a negative result. Across all 13,000 filings, in every clarification ever written, the words token, blockchain, smart contract, crypto, and wallet appear 0 times. Not once in 11 years. There is no hidden crypto surcharge in the record because there is no crypto line item in it, which is why nobody planning a tokenization can look this up and why the vendor pages say what they like. And among the issuers who do itemize what those 7 lines miss, the leftover runs about 3/4 of the legal and audit bill on top. Then the lane where the fee table reads 0. 915 filings report 0 legal and 0 audit on a real raise. Masterworks and Rally are nearly half. Not an error. Masterworks pays all offering expenses, so gross proceeds equal net proceeds. What it charges instead is an expense allocation of 11% of the artwork price, about 1/10 of every dollar. A 0 fee line does not mean the offering was free. It means the investor pays somewhere other than the fee table. Tyrios runs the identical structure with tokens, and the cost this census cannot see at all. In May 2025, Hero Systems, formerly Blockstack, told the SEC Crypto Task Force what it costs to stay. About $450,000 a year outside, $500,000 more inside, upwards of 7% of annual expenses. Its own board had voted in January 2021 to stop treating the token as a security. It filed the exit report 4 years later. Compliance is a subscription, not a fee. So what does it cost to tokenize an asset? 3 answers, and you have to say which one you mean. Issuer pays. Roughly $40,000 in legal, $15,000 in audit, estimated. $35,014, actual. Sponsor absorbs. The fee table reads 0, and the cost surfaces as a share of the raise. About 1/10 of gross at Masterworks. Ongoing. The census cannot see it, and the one issuer who published a figure said roughly $950,000 a year. Anyone who quotes you a tokenization cost without naming the lane is selling something. 4 issuers paid between $1.2 and $2.1 million in legal fees to establish that a token could be a public security in the United States. The precedent survives, and everyone since files into it at ordinary rates. Every number here is a mandatory disclosure, filed by the issuer, with the law firm named, still queryable 7 years later. New episode every week for the people actually planning to tokenize large things. Subscribe.